Hi everybody, CapitaLand have 4 REITs and 1 business trust listed on SGX, and all 5 of them has released their FY2021 financial result in end January and February. Today, I'm going to talk about the financial results for the 4 REITs, which are CapitaLand Integrated Commercial Trust, Ascendas REITs, CapitaLand China Trust, and Ascott Resident Trust. I'll not touch on Ascendas India Trust, which is under the business trust category, and I'll talk about that in other videos. Let's look at CapitaLand Integrated Commercial Trust FY2021 financial result. For the second half of FY2021, they post a DPU of 5.22 cents, which is actually lower than 1 year ago, the second half result, which is 5.73 cents. And let's look at the portfolio performance as a whole. Currently, the portfolio occupancy is about 93.9%. And we can see that the tenant sales for the portfolio have increased actually 12.2% year-on-year basis. That means it's compared with year 2020. And you can see the suburban mall have increased by 13.4%, while the downtown mall have increased by 10.3%. However, do take note, 2020 is a low base. So we are comparing from a low base to current year. And thus, we can see a double-digit increase. However, that doesn't mean they are out of the wood already. And now, average portfolio rental is up about 2.6% based on a quarter-on-quarter basis. CapitaLand is a Singapore-focused REITs, where currently 96% of the property are all located in Singapore, with only 4%, actually it's only 2 office buildings in Germany. From this table, you can see that the full FY2021 gross revenue and net property income is a lot more compared to FY2020, as this is the first time the full year result of the Capital Mall Trust and Capital Commercial Trust merged, plus Raffles City Singapore is considered inside under as a whole. And thus you can see a big jump in revenue and big jump in net property income. Let's look at their retail performance, where they got a portion of suburban mall and also a portion of downtown mall. And from here, you can see that when compared to 2019 pre-COVID level, the Southwest traffic have only recovered up to 61.2% of 2019 level, while the tenancy is 87.8% of 2019 level. This means that they are still not really out of the wood yet currently, and which also means that there is more growth potential if Singapore economy were to continue to open and virus is under better control, and there's more growth potential for them. And you can see that they suffer a negative rental reversion of 7.3% when compared to 2019. And compared to 2020, actually is 3.2%. You can see that the occupancy rate for the retail mall are all very high, and are all in general higher than the Singapore retail occupancy average of 91.9%, except for Clarke Quay, where you can see it is 73.5%, as Clarke Quay is badly affected by the government restriction on trading hours and sales of alcohol at nightlife, like pub clubs, karaoke joint, bars without food license. And the risk manager is going to take some action on Clarke Quay, so we can put this Clarke Quay aside, as they may going to do some AI on Clarke Quay going forward. The rental reversions, okay, is still negative, but we can see that the decline rate has started to slow down on a quarter-to-quarter basis, which is quite a good news to the unit holder. From this chart, you can see that the tenant sales and the shopper traffic in general is still way below 2019 level. The suburban mall have a performance compared to downtown mall. Okay, let's look at our office performance. Our current office occupancy, including Germany, is 91.5%. We take out Germany, is for only Singapore property is about 90.4%. Okay, let's look at the occupancy rate of the office. You can see that for Capital Tower, the occupancy rate currently is 76.8%, as there's tenant move from Capital Tower to the newly TOP office called CapitaSpring. And however, currently there's 17.7% of the net lettable area of Capital Tower is under advanced negotiation. So we'll expect the occupancy rate to increase quite significantly in the next quarter. And 6 battery roads, where they are currently doing some partial upgrading and they are completing in phases, the occupancy rate actually currently based on January 2022 actually is 89.3%. This occupancy is based on 31st of December. So actually the occupancy rate actually have already increased by 10% for 6 battery roads. Then look at the integrated development, where actually they got 4 properties. One is the Raffles City Singapore, one is Funan, Plaza Sing, and CapitaSpring. And we can see for the 3 existing property, their occupancy rate is at least 94%, where CapitaSpring is just a new property that just TOP in November 2021. The occupancy rate currently really at 91.5%. Actually, is a pretty good result for a brand new properties. Now let's look at their balance sheet. The NAV actually has increased over time, and currently it now is at 2.06. And look at their gearing. Their gearing as of 31st of December is 37.2%. It have dropped from 40.9% to 37.2%. But however, do take note that they have done an acquisition on Australia properties, which will be completed in Q1 2022. And after that completion, the gearing will go back up to 40%. And a lot of people are concerned about interest rate risings, as that may have a negative impact to REITs as a whole. However, when you look at these REITs, their number of percentage on fixed borrowing is 83%, and their average term to maturity is 3.9 years, which means that they actually have locked in a lot of fixed interest rate for the REITs. Thus, the impact on interest rate increase to the REITs will be contained in that aspect. This is the price chart performance. As we can see that for the past 2 years since the COVID to now, CICT have been moving rather on a sideways basis, and currently they are trading around their NAV levels, which is 2.06. What about the growth prospect of CICT? The 100-meter underground pedestrian link to Funan from City Hall MRT is already open in December 2021. This will improve traffic flow to Funan Center, as it is sheltered all the way to Funan. And also, they have been constantly reconstituting their portfolio, where we know that they have sold off, divest 50% of their One George Street. And they also make an announcement that they're acquiring property in Sydney, Australia. And this is their very first venture into Australia, where they are acquiring 3 properties in Sydney. But do think after acquiring these 3 properties, which will be completed in Q1 2022, the gearing of the REITs will go back to 40%. And they have also divested of JQ at 340 million. And thus at the Jurong East side, they only left 2 more, which is the Westgate and the IMM. And we can see the AI work for 21 Koloki area achieved TOP. And also the 6 Battery Road AI will be completed by 1Q 2022. So with these 2 properties, they have already finished the AI work. We will expect income to be coming in from these 2 properties, most likely in the second half of this year. Indirectly, we'll see that the MPI is supposed to increase in the second half of this year. And CICT, the manager, have mentioned that they will remain Singapore focused, but of course, they will look for overseas potential to grow. Their focus will be 80% Singapore, 20% overseas. Currently, the Germany only contribute 4%, plus the Australia property coming in, it still be less than 10%. And this year, most likely, they're going to acquire properties. And this time, the property acquisition will be Singapore. As for whether are they buying a shopping mall or office tower in Singapore, that one will be anyone's guess. You can leave your comment below to guess what property was CICT going to buy this year in Singapore. Let's look at the second largest REIT in Singapore, and it's also the largest industrial REIT in Singapore, which is Ascendas REITs. Ascendas REITs have reported a 2.4% increase in their second half FY2021 DPU of 7.598 cents. This makes their full year DPU to be 15.258 cents, which is 3.9% higher than 2020 DPU. So you can see that they are actually on the path of recovery. However, this still falls short of 2018 DPU. 2019 is only 3/4, so you can't really compare on that. But the 15.258 is still lesser than 2018. So we expect them to continue to grow to catch back the high of 2018 and go even higher. It is a REIT that got more than 200 properties diversified across many 4 regions, the US, Australia, UK and Europe and Singapore. And it encompasses practically almost all the asset class industrial REITs should have. The business space, the logistics, the industrial, and the data center. Let's look at their key highlights for 2021. And you see I mainly focus on this DPU. Have the DPU increase over time. So it increased by 3.9% year-over-year based on 2020 basis. And also it achieved a positive rental reversion of 4.5%. And the current gearing actually is very healthy at 35.9%. Let's look at our occupancy. The occupancy for the Singapore, Australia, and United States actually have increased compared with 2020. It's just that the UK and Europe occupancy have dropped slightly to 96.7%, but overall the total portfolio occupancy rate have increased from 91.7% to 93.2% compared to 1 year ago. And you can see that they have achieved a very positive rental reversion, be it in Singapore, US, or UK and Europe. And let's look at their balance sheets. Their current adjusted net asset value is $2.31, and this REITs constantly trade at a premium. And their aggregate gearing of 35.9%. And with the size of the REITs, it means that if they were to make any big acquisition going forward, unlikely they'll need to do any form of equity fundraisings, where they got billions of dollars of headroom for them to do big acquisitions. And the percentage of fixed rate debt is 79.4%, which is an average tenure of 3.5 years. This means that they are actually well positioned for the interest rate hike. But let's look at what is the impact if there is really an interest rate hike to the risk. If there's a 20 basis point increase in the interest rate, the distribution, that means the DPU you're going to collect will drop by 0.06 cents, which is about 0.4%. However, this is based on a pro forma impact. It is with the assumption that there is no increase in their rental, increase in their income. So if their MPI and the DPI are increased much higher than 0.4%. So even a 20 basis point interest rate hike, you still see that the REIT's DPU will still continue to go up. And we have seen some weakness on these shares lately, but the past few days, you have started to bounce up from the low. But currently, industrial REITs as a whole or REITs as a whole, they are feeling some downside pressure as people are concerned about interest rate increase. What about the growth potential at Ascendas? The no news of Ascendas is the redevelopment of One Science Park, which they ever announced in 4th quarter last year. But this redevelopment will only completed by 2nd quarter 2025, which is 3 years later. So for Ascendas to continue to grow in the next few years, most likely they need to go on some more acquisitions, maybe overseas. And with their current gearings and their current size, Ascendas are able to do big acquisitions without doing equity fundraising, and you see this will usually resulted in a year equity acquisitions, which is good for unit holders. And let's hope that will happen in this year. And the third risk for CapitaLand will be the CapitaLand China Trust, which actually have announced a 35.1% rise in the second half DPU to 4.5 cents. Do take note that, as I mentioned, that 2020 is a low base, and 2021 starting market is also quite uncertain. So 35.1% rise in DPU actually is just on a path to recovery. However, with the current FY2021 total DPU, their DPU yield currently is around 7.7%. This is based on $1.14 as of 20th of January 2022, which make them one of the highest yield REITs in Singapore. And CapitaLand China Trust have been listed in 2006 as a retail-centric REIT, and they have started to transform to a multi-asset REIT. And let's look at how is the contribution currently. Currently, they are still very retail-heavy, where 78.1% of their assets are still in the retail side, where the new economy only contribute about 21%. And Beijing is still the higher weightage at 38.9%. And when compared to the full year 2021 and 2020 result, you can see that their DP actually increased by 37.5%. Everything increased drastically as we are starting off from a low base. So we'll need to see this year how are they performing and compared to 2019 pre-COVID level. This is our retail portfolio where they currently have 11 assets. And we can see that the tenant sales actually have improved compared to 2020, but I think compared to 2019, it is still quite a distance away. And the occupancy rate is very high. In January, average is 96.3%. The only one that is low is CapitaLand Chipa, which is 81.8%. One thing negative about this REIT is the rental reversion is negative. Currently, is minus 3.4%. As we know that shopping mall is very affected by COVID. And especially China and shopping mall shutdown is quite common for them. And they actually have suffered a significant number of days of shopping mall closed down in 2020. Let's look at the business park where currently they have 5 assets and the business park occupancy rate is on average pretty high, is 96.2%, and actually is higher than the industrial average in China for all their 5 asset class. And the business park rental reversion is positive at 7%. And the logistics park currently got 4 properties, which they also enjoy a very high occupancy rate of 97.4% and also a positive rental reversion of 2.7%. However, the new economy currently only contribute only about 21% to the portfolio. Thus, the impact of the retail side is still pretty big to the REITs as a whole. The adjusted NAV is $1.54, where they are currently trading at quite a significant discount compared to their NAV. One thing because of their retail focus and also because of their shopping mall, which are not really performing well. And their gearing is 37.7%, which is a pretty healthy gearing. And the amount of debt on fixed rate is actually 77%, which is also very high. And this will actually able to cushion the interest rate rise for the REITs. Let's look at the price chart of these REITs. On the last quarter, there is some downward pressure on the price, and you can see the price have slowly declined down, now currently trading around $1.20, and it's still a gap from the NAV level of $1.54. Were they able to recover back to the NAV level? That will depend on how the COVID have turned out and how fast can they transform the REITs over time. The positive about CapitaLand China Trust is they are slowly transforming from a pure retail focused centric REITs to a multi-asset REITs, but this will take time. And their ultimate target is by 2026, where their retail only take up 30% weightage, where the new economy take up 30%, and the commercial integrated development take up 40%. But do think that in order to do this transformation and in order for the REITs to grow, one thing is either they sell off their retail malls, or if not, they need to buy some more new economy and commercial integrated development. And with that, most likely because of the REIT size, you should expect some form of equity fundraising along the year when they start to transform to this by 2026. So unit holder need to take note of that if you want to invest in CapitaLand China Trust. The last REIT I'm going to talk about for CapitaLand is Ascott Residence Trust, which is a hospitality trust. Ascott Residence Trust have posted a 14.1% rise in their H2 DPS, and they also have set target to grow their long stay asset. They are also transforming themselves to remove their volatility based on the short stay side, especially when COVID come, it actually had hit the hospitality trust quite badly. So it is a leading hospitality trust. We currently have 93 properties, and in fact, it's the largest hospitality trust in Singapore. And if we were to combine all the properties of all the other hospitality trusts together, I think in terms of number of property, they are just on par. I mean, all the property of the other hospitality trusts listed in Singapore add together, the number of properties is just similar to the property of Ascott Residence Trust. From there, you can see the breakdown. They got 54 of them are under service residence. This is considered service apartment. 18 are hotel, 14 are rental housing, and 7 are student accommodations. Let's look at their FY2021 highlight. You can see that they have a 43% increase in the distribution based compared to 2020. As I'm always mentioned, it's always from a low base. So a 43% doesn't mean they have really out of the wood. One thing I can see that they have enjoyed 6 successive quarters of RevPAR recovery. So they are on the path to recovery. Let's look at their financial performance by contract type. They got a master lease which contribute 51% of their gross profit, where their management contract with minimum income contribute only about 3% of the gross profit, and their management contract which contribute about 46% of their gross profit. In total, their gross profit has grown by 16% as a whole. This chart will give you a better view of how stable income will help these REITs. As master lease and management contract take out 64% of the REIT's gross profit, it give a stable income to the REITs. That 36% is based on management contract, which we call the growth income. Means that if opening more travelers, then the income have increased, then they'll get a better cut. But when you invest in REITs, you also want certain form of stability, where currently got 64% of the income are more towards the stable side of income. This will make the REITs a more stable REITs. The current gearing is about 37.1%, which is actually a pretty healthy gearing. And the interest cover is 3.7 times, which they have actually recovered back from the COVID time. I do think the MS requirement is 2.5 times. And during the COVID period, MS actually have waived off this 2.5 times requirement, where many hospitality trusts, their interest cover have fallen below 2.5 times. And you can see that Ascott Resident Trust have actually recovered, and the interest cover currently is 3.75 times. It is on a more of the healthy level. Now, same thing, all the REITs are actually pretty well prepared for interest rate hike. And we know that interest rate will go up and will go down. And how the risk manager actually manage the interest rate hike is they will usually put main bulk of their loans under fixed rates. Currently, you can see Ascott is 74%. So you can see that the 4 CapitaLand REITs, all their fixed rates are actually all more than 70%. So this will reduce the fluctuation of the DPU when there is a spike in interest rate. And this is the past 2-year price chart. You can see that for the past 1 year have been trading sideways around the $1 mark due to constant stop, opening and closing of the economy, and thus it is still trading sideways, which to me it may be a potential going forward when the whole global economy has started to open up. We can see that more countries have eased their movement restriction in second half 2021. Do think that this REIT is a global REIT where they have properties globally. So when the country have opened up their movement restriction, actually it will benefit the REITs as there will be internal domestic travel within the country. And also more countries have reopened to international travel in second half 2021, which will also benefit the REITs globally also. And we can see that for international travel, it have rebounded 128% and 85% year-on-year for America and Europe respectively in second half 2021. And all these are actually a positive catalyst for the REIT. And the last part which I like about this REIT is the reconstituting of the portfolio to provide income stability. You see, we bought this REIT is mainly as a tactical play to position for the opening up, to position for the recovery play. But this REIT also want to position itself so that you can do it as a long-term investment where they can deliver a stable income over time. And how they do it is by increasing their student accommodation and rental housing holding. Currently, it contributes about 15 to 20% for the long stay accommodation, and they're going to increase to 25 to 30% over a longer term period. This will create more stability to the REITs as a whole. Above is the financial result for the 4 CapitaLand REITs, and also my view on them for going forward for 2022. If you feel that this video has benefited you, do remember to like and share, and also to leave your comment below to let me know what you think. And also do remember to subscribe and press the bell button so that you'll be notified on my next video. I shall see you in my next video. Bye bye.